Manhattan Street Capital and we're not underwriters, we're not broker-dealers, we're not attorneys. What else is there? We're not valuation professionals. There's a lot of things that we're not. So I don't want to. So I don't want you to take anything I'm saying as being pretending to be an advisor of those types, because I'm not. We're not. Um, and just to give you myself a couple of minutes of explanation here, so you know where I'm coming from. I started out my career as an engineer, got into entrepreneurship. I've had the good fortune to play a key role in building 6 successful technology startup companies to liquid outcomes. 2 of those were IPOs to the NASDAQ. One of them was Ashton Tate, which certainly ages me. That was an IPO in November of 1983. And Symantec is the second one, which is also pretty ancient at this stage. I've done a venture capital firm called Irvine Ventures and an incubator along with that, which we did in the Safi Qureshi and I did in the beginning of joining the first internet bubble. Oh, by the way, I suggest that you use Zoom in this way, that you select it to speaker view. Everyone's muted so that we don't have too much background noise. And we will take, if you'd like to give us questions, give me questions, please at any time enter them in the chat box, and then I'll do my best to answer those later. So just whenever you feel like it, go ahead and enter those questions. We'll start at the top of the list and work down it when we get into the Q&A section. Yes, so I launched this company, Manhattan Street Capital, in May of 2015 because of Reg A plus. So we've been involved in this space for a long time and have a lot of relevant experience. We help companies raise money, we consult with them, we advise them, and we put them on our offering page, and we do a lot. We bring in all the various service providers to help make successful offerings. So today's webinar is about comparing Reg D, Reg A plus, and Rule 144A. If it would be lovely for me to hear from you guys, how many of you are already familiar with 144A? I find it quite interesting. Well, I'll get into the why I find it interesting part in a minute as a part of the agenda. We'll talk about liquidity, obviously. And I'm also going to talk a little bit about marketing and how things are shifting and changing, because I'm seeing a lot of adjustments in the changes, the evolutionary and significant changes in the online solicitation of investment and engagement as well. So without further ado, let me just sip some more tea here and launch into Reg D. There really are only 2 viable forms of Reg D for solicitation online. And of those, 506B is the less viable and 506C is more viable. In the case of 506B, like in Reg D, you can raise unlimited amounts of money. That's a lovely thing. It's limited to accredited investors. In 506B, you are allowed to bring on board up to 35 non-accredited investors. The big limitation, though, is that you may only approach accredited investors that you have a relationship with. So you can't run ads online and bring in people who are accredited. You can't buy a list of accredited investors and send out emails to them inviting them to invest, because you don't know them. So that's a serious restriction on 506B, which is why we have never done a 506B. Obviously, when you're doing when you're raising money and you know the people, 506B is a very relevant way to go. An advantage of 506B, which is great in that situation, is that the investors can self-state. They can state that they are accredited. They don't need to prove it, and we don't need to verify it. So that's a big advantage. And then, as is the case with 506C, you are required or expected by the SEC to file a Form D with them within 30 days of receiving your first investment in the Reg D, but that's pretty easy, and it's not a request. Can we please do this? It's a statement that you are doing it and what the terms are. And the 506C is a whole different case. So 506C and B, when effective in these forms, when effective in September of 2013, as actually the first online crowd investing methods permitted by the SEC. 506C is great because we can market it far and wide with really only very reasonable restrictions. Although the downside is 0 non-accredited investors are allowed, and the issuer company must take reasonable steps to verify that those investors are actually accredited. So they have to prove it. And that's a pain in the neck, right? So, and it's an ego thing too. So some people just don't want to do it. Older investors get stuck doing it. You know, I mean, just playing the skeptic side of that for a moment. That is the case. But 506C does work, and there are a lot of people out there who invest who are accredited in 506C offerings every day. And we've been making great strides in figuring out how to effectively market to them. That's been something I'm very, very pleased about, progress that we've made in the last year. Okay, so in comparison, Reg A Plus is a different puppy. It has the ups. I'm going to talk about tier 2 because tier 1 is almost a waste of time. Probably in the year 2020, 2% of capital that was raised via Reg A Plus came in via tier 1. So I don't want to dwell on tier 1. Tier 2 starts at 0 and now goes up to $75 million per year. So it's capped, but it's also a large number for many companies. But you can do it, and you can do it successive years, right? You can do it year after year. Investors of any wealth level, including accredited investors. Accredited investors are not limited as to how much they can invest. Non-accredited investors are limited. It's all self-stated by the investor, and we don't need to prove or verify it. Non-accredited investors can invest up to 10% of their net worth or their annual income per offering, which is really a very generous, very big number, right? Somebody making 200K a year, say 100K a year, they're non-accredited, they can invest $10,000 in your Reg A Plus. That's a lot of money for that person at that income level, especially because they can do the same thing in the next Reg A Plus they like. So it is really not very restrictive. You are allowed by the SEC to market the offering worldwide, which is not to say that the local regulators will approve of it. We haven't had any problems except in Canada so far. In Canada, the federal regulator just said you got to go to the states. You got to get permission from the states. Fair enough. The states, you know, the other word that I've forgotten for the regions of Canada. The restrictions in promoting, describing, and marketing a Reg A Plus are more limited than, they are more tight, if you will, than in Reg D. In Reg D, you can make some predictions about returns you can make predictions about accomplishments you intend in your business. In the case of Reg A Plus, you have to be very careful because the SEC does not want, they're protecting Main Street investors, you know, mamas and grandmothers and, you know, people that could be fooled easily. Therefore, grandiose statements are never allowed anyway. You know, like we have the cure for cancer, you know, something extreme like that is obviously not going to be allowed. But you cannot say we're acquiring companies and we're going to acquire 50 companies in the next 12 months. That's not allowed. That's just too much of a predictive statement, then it may not come true. Being as how we're all entrepreneurs here, and you've got to be an optimist, it's almost certainly not going to come true if we face the reality of it. There's no blue sky requirements for registration, with some peculiar exceptions that I won't dwell on at great length here in a Reg A Plus, so in a tier 2 Reg A Plus. So essentially, you can pretty simply raise money. It takes, if your company has existed for 2 years or longer, you need a US GAAP audit to do a Reg A Plus. That's an expense and a hassle. and you have to file with the SEC to file a Form 1A in order to get qualified by the SEC to conduct your Reg A plus. So you're talking about a 4-month journey, 2 months of preparation, 2 months to get through the SEC process, and front-loaded expenses for the audit, for the securities attorney, and so forth. So reckon that it's going to cost 150K, roughly speaking, to go from we're starting this to, oh, great, we're qualified and now we can raise money month 5 or thereabouts, assuming an efficient process. That's, you can spend a lot more, you might be able to spend a bit less, but that's, kind of that's a pretty reasonable number to consider at the low end of the range, including everything, not excluding anything, including all expenses. Once you're qualified, you've had 12 months to raise the money, and it's a heck of a lot easier to raise money in a Reg A plus if you are marketing an offering that is appealing to Main Street investors. There's so many more people. So many of them didn't have these opportunities before. And if they love your company or like what you're doing or find it an exciting investment, then it's very much easier to raise money from them. Reg A plus investors are optimists. Reg D investors are generally pessimists. I'm a bloody pessimist. I've done so many deals where I've lost my shirt. I've learned the hard way that I need to be a pessimist, as have many other accredited investors. And let's face it, when you're accredited, you have a bazillion opportunities of places to put your money. We've had instances when people come through from advertising to an offering on Manhattan Street Capital, we require them to see the investment process or to invest. We require them, they click a button and they have to give us their email at least. And so then they're part of the engaged audience that our companies market to, and the marketing agencies market to. We build a bigger and bigger audience. So we've had days recently where out of 10 people who would give us their email from clicking on that button, 7 of them would invest on their first visit. So when that's happening, obviously this is an exciting offering, but you also know these are optimists, right? A pessimist would look at it, click on it, check it out, come back later, ask the wife, do some research, probably not ask the wife because the wife's going to tell him, no, don't do it anyway. But you know what I mean? There's optimists who we're dealing with, so we need to protect them and make sure that they're fully informed and don't really expect them to read the offering circular. 150 pages is a little bit heavy going, so let's be real about that. But anyway, Reg A plus, you're dealing with optimists, and if you're doing it right and you've got a compelling offering, 60% of the money is invested now via smartphones, and it takes 3 to 4 minutes, 5 minutes. It's such a different situation than we used to have. It's a very nice dynamic. Okay, so I've given you a sort of a top-level summary there of the differences, actually, of 506B and C and Reg A+. I'm now going to touch on what Rule 144A is. Probably a lot of you don't know about it. I didn't know about it myself some time ago, and then I learned of it. We have a potential client that has a really sophisticated company, investment company, lending company that has an amazingly complex deal that's very hard to understand. But he ends up with these revenue percentage streams being paid out over time in a very secure manner, and he's able to create investment grade securities, and then he needs to sell them. It turns out Rule 144A is the best way to do that. His first deal is about $1.6 billion. So we're not signed up to do that yet. It may never happen, but in the event it does, that'll be rather cool. And the point is, I had to learn about what 144A is about. So what makes Rule 144A currently attractive, in my view, is the combination of 2 new developments. So I see it as a rather attractive opportunity to raise money where a year or 2 ago it wasn't. So I'll just state those two changes, and then I'll get into explaining what it is. The 2 changes are these. We are seeing serious institutional engagement in Reg A+ now. And that's a new thing. You know, a year ago, we almost never saw it. 6 months ago is when it started. I don't have a graph to show you to prove it, but it's happening. It's happening it's happening in a very rewarding way. So I suppose you'd say that Reg A Plus has grown up and is being recognized as a merit, as a respectable way of raising money on a selective basis. That's a huge change, huge. And the other thing is that we're seeing the emergence of, because of regulatory reform, we're seeing the emergence of alternative trading systems, ATSs for short. So a company can make a Rule 144 offering, 144A offering, and effectively go public and list on an alternative trading system with very little overhead and very little upfront expense. The downside being that it can only raise money in the US from QIBs being qualified investment companies, which essentially means companies that are smart enough to know what the hell they're doing. They have to have at least $100 million of other people's money that they're able to invest. So this is an institutional offering, but this is where we get into how it works, and I don't want to get into too much detail. I don't know how many of you are interested in this, but I find it rather an attractive method to go public with, in the sense that if the securities are tradable, which they are instantly on as soon as listed on an alternative trading system, and you did that, and you were able to do that with the other advantages of 144A. This is a new route to liquidity that is worth considering. So these are the way it works. This is the way it works. A company decides to take this approach. The filing requirements are nominal. The offering documents are nominal and minimal. You don't have to do a Form 1A Reg A Plus filing with the SEC. You don't do a registration statement. There's an exemption for 144A offerings because it's assumed by the SEC that these entities are smart enough to know what the hell they're doing. So the first step is the issuer sells the securities. This is the sort of weird part, to an accredited investor via Reg D. And then that investor is able to market them online. The marketing can go wherever it goes, but the only people that can invest are those that are QIBs, these qualified investment businesses, QIBs, yes. And reasonable steps must be taken to make sure that they're the people that are investing. They are immediately liquid in the SEC's eyes. And once the securities are listed, then they are actually immediately liquid and can publicly trade these securities. So essentially, when you have an offering, when you have a company that is attractive to institutions, this is a very attractive way to raise money in my book. It's a simple way to get securities listed and then trading and raise money. So I'll pause on that, and I'll get into other aspects of this. Somebody's messaging me, make sure it's not an urgent thing. No, it isn't. Okay, so that is why I think 144A is now an interesting phenomenon, interesting vehicle, really. And so now I'll talk about liquidity and other aspects of these different methods. So Reg A plus liquidity is excellent. You have these options. You can go public on the NASDAQ. You can go to the OTCQB or QX. If you do the QB or QX, then on the QB, your reporting obligation is the same as anyone having completed a Reg A plus Tier 2, which is annual GAAP audit, US GAAP audit, 6 monthly management financials, and of course, any material change in the business. You can list on an alternative trading system. The beautiful advantage of doing so, the downside is they have less liquidity and they're new and they're emerging. The upside is that there are no shorts and there are no naked shorts. So unlike listing on the OTC markets or on a major exchange, many companies which are not really ready from a management bandwidth point of view or stage of business or predictability of returns and profits, many of those companies really aren't ready for the rigors of exposure to naked shorts, which stockbrokers are allowed to put on all day, any day they want. So, unless you're prepared to handle that, going out on those exchanges is a marginal blessing. Going on an ATS is a much better bet from that point of view. Okay, other aspects of Reg A plus liquidity. You can offer limited direct liquidity to your investors. It's limited by regulation M for mother. And the upside of Reg A plus that is not, I think, generally understood is that completing the Reg A plus makes all the insiders liquid. All of the older investors and the owners of the company, everyone is liquid. So there are obviously constraints on that, like the insiders and passive investors who own more than 10% of the company are restricted to only selling during a 2-week window after the company has reported results or an audit, results through an audit or management financials. So that's pretty restrictive. And during that window, they're restricted to 1% of float. And float, the volume trading each day is that limit applies to each day. That depends heavily on where you're listed, right? So an ATS isn't going to give you humongous amounts of volume. And if you have 4 classes of securities, then to make it really easy for each group of people who own those securities to trade them on an ATS or anywhere else, they have to be listed actually, right? So you have the extra expense of that. It does make it encourages you to keep the variety of securities you offer simpler. And it encourages you, if you're nervous, to lock up some of your people before you do your Reg A plus, just as you would in an S1 IPO. Anyway, so there's the cool thing is, though, if you look at it on the positive side of this ledger, your long-term investors who don't own more than 10%, they're liquid immediately. And if they can find a buyer, they can sell to them, or when you list someplace, they're able to sell, and they aren't restricted to when the most recent results were reported. So that liquidity is lovely for them because, in some cases, they've been around a long time. These overnight success stories take a while to build, in my experience. Okay, Reg D liquidity is better than it seems. In general terms, typically 1-year holding period before any transactions. However, private sales of Reg D securities to other accredited investors can be made immediately after purchase in a Reg D. I didn't know that until I studied it some time ago. Similarly, under another exemption, 4A7, same thing, privately securities can be sold. That means it can't be listed publicly. You can't be marketing that online. You can't be promoting it, but privately those transactions are allowed. And obviously privately to more institutional investors, like these qualified institutional buyers, which is the proper term for QIBs. That would be under Rule 144A, and that's allowed at any time. And then publicly after 1 year has passed. So that doesn't mean the shares are easily bought because the company is probably not listed. But after a year, those Rule 144 holding period has passed. Then those accredited investors' investments are actually publicly tradable if they can find a buyer. That's pretty good. So, and the equivalent I mentioned already for 144A is that the QIBs are liquid immediately. And by the way, when you do this offering, Reg S investors are allowed they're liquid immediately too, as long as they don't sell to US investors. So international buyers of the 144A offering, they're allowed to sell right away outside the US, as far as the SEC is concerned. So again, this is an interesting avenue to get a company liquid and raise money. Okay, Reg D liquidity, already said that. All right. Comparing these different methodologies of raising capital for companies. Let's see how we're doing on time. Good. Excuse me. So Reg D and Rule 144A are dead simple to start. You don't have to go filing a lengthy report and ask permission from the SEC and get qualified, et cetera, et cetera. So the upfront expense and time involved in getting started are minimal. It's going to be gated by how quickly you can put the marketing together, really. That'll be the long leg. So I would say 4 weeks to 6 weeks is realistic to go live with a Reg D online or a 144A. We will provide the service of buying the security in the first place and then putting it on our platform to sell it to the aftermarket. Because if you heard what I was saying earlier, in a 144A, essentially there's this two-step process where the issuer sells to someone, and that someone then is able to sell through the 144A publicly through online marketing, and we'll provide that service to any company that any company within reason that wants that. So you don't have to have audits in place to do Reg D offerings or 144A offerings. You do in a Reg A plus. It's entirely reasonable, but that's a difference, right? There is no limit on how much you can raise in a Reg D or in a 144A offering, whereas there is a limit of 75 mil per annum in Reg A plus. Still a thing, Reg A plus and 144A are different methods of getting your company public. Obviously, public with 144A is a constrained public in the US, right? That's these quibs only. And outside the US, all the Reg S investors are effectively liquid. But it's not the same as a Reg A plus, where it's a thing of beauty for bringing a company public in the normal sense of the word. With Reg D and 144A, there's virtually no online reporting requirements. Obviously, businesses need to be above board and things, but there are no, audits requirements, and there's no ongoing big obligation of an ongoing reporting of ongoing events in a Reg D or a 144A. In the case of Reg A plus, a huge advantage, which we live and breathe every day, is that you can market the offering to non-accredited investors. And as I said earlier, they're optimists. And if it's the right offering, if it's an offering that's well marketed, then, we can bring the cost of that advertising down. The lowest we've been able to get it down to date was $3.50. No, actually $3.30 spent on advertising per $100 raised in a Reg A plus, which is one of those things. We'll probably never repeat that for a long, long time, if ever. But that is a really good indication of how, when it works well, right? That's the biggest expense in a Reg A plus is the advertising. In their case, it was a biotech. In their case, their total expense, including everything, was about 6.5% cost of capital. And that was a relatively small raise. So the percentage would have been far better if they'd raised more money, which they chose not to do. Reg D and Reg A and 144, it's not Reg 144, Rule 144A are much less expensive to start, right? You don't have the securities attorney setup expense and so forth. It's a lot more straightforward. Okay. So I'm going to give you a couple of examples of things that you can do with these different capital raising systems. Really only a couple, because most of it's obvious. Can you do a venture capital fund? Well, in the case of Reg D, if you raise money with less than 100 investors, so 99 investors or less, then yes, you can. You can raise money to go out and do private equity investing, to do venture capital investing, essentially as a blank check company, and without any restrictions on how much equity of those companies you invest in that you will have or that you lend to. Okay, so that's a nice thing, except it's not a nice thing to have to cram it all into 99 seats. but you can do that. We did an offering with to buy. We did an offering with a fund that was put together in this manner last year in the summer in order to raise money, in order to buy securities from Impossible Foods shareholders who wanted to diversify. And that's what we did. And we were remarkably successful with that raise. It was difficult because, you know, you wanted to raise large amounts of money per seat. That made it more challenging, but we were still very successful with that raise, only marketing it to our investor list, which was a very pleasant surprise, actually. I didn't think it would go as well as it did. So that's one example. Another example is in Reg A plus, where it's one hell of a lot more difficult. But essentially what it comes down to with Reg A plus is this, that if you happen to be early stage venture where you own large amounts of the companies because you're putting them together, then the majority of your investments will be for controlling interest in companies. Then you can use Reg A plus until the cows come home as an investment fund to do that. The problem is that, you know, typically in a typical venture capital fund, you're not buying more than 51% of a company, are you? Normally you're getting less than that, in which case really Reg A plus doesn't work unless you combine the investing portion with a lending portion, where the investing portion is essentially less than 40% of assets and the lending portion is more than 60 or more. And the nice thing there is that where the investing bit is in warrants, they don't count as assets. They don't count as securities until you buy them, right? So you could have a situation where you are doing a lot of really interesting equity investing through warrants through a Reg A plus entity, funded entity. And yet, you know, you're getting minority positions, but your actual exposure is better than it seems, if you see what I'm saying, because of the fact that warrants don't count until you exercise them. Okay, those are the main things that I wanted to hit on. So I'm now going to go to look at the questions that you guys have posed, and bear with me while I do that. And if you'd like to add more questions here, I'll be happy to take them. I'm going to try and optimize the screen here. So I can see the questions. Bear with me a moment, guys, while I do just what I said. Okay, good. I hope this has already been really informative, and I look forward to seeing what questions you have. Disclosure, yes, good. Well done, Akash. Oh, somebody asked about recording. We are recording it. I would rather you didn't, but I suppose it's okay. You know what? I don't really want you guys to record these sessions, because what we'll do is we will convert this into a recording. And if there's something I said that turns out to be factually incorrect or provocative of the SEC, we'll delete that part before we publish it. And I don't want to have me saying the wrong thing someplace getting proliferated. But I didn't see a question till now. Okay, can 144A go on long-term stock exchange coming on? Don't know. I don't know what the long-term stock exchange is. If it's an ATS, then yes. Regarding Reg A plus, can you define potential risk relative to class action suits by investors? Good question. So the primary thing with Reg A plus to limit litigation exposure in the future is as I see it, is two things. Three things. Really good preparation of the document, so all the risk factors are clearly delineated. That reduces exposure, obviously. Secondly, make sure it's a really good company and there is good ethics everywhere. Oh, that's so bloody obvious. And thirdly, let's be a bit selective about who we bring on board as an investor, right? So on that front, we do things in our platform that are above and beyond, both when we're doing AML and beyond that. We have an algorithm that monitors people's activity in our website, everyone's activity actually. And we can, from that, flag, I would say, dangerous behavior that indicates a low quality investor. So that plus the more in-depth work beyond the AML allows us to essentially avert some risk, recommend to our client companies when they shouldn't accept that investor, because you don't want the money if it's going to be a risk down the road. Somebody that has had 4 personal bankruptcies might not be the kind of risk you want to take on, right? But after that, I'm not aware of any post-offering litigation in Reg A plus. That doesn't mean there isn't any, but I'm not aware of any. And I would probably be aware if there was. I think the bigger risk is that the SEC will find something unacceptable about the way a Reg A plus was promoted. Excuse me. And there have been some instances of that. That's the bigger risk, I think, and that's where we play a big role, is helping companies do it right. Okay, how much does a 144 cost to set up? I would say, including the biggest expense is going to be in the marketing aspects of it, so probably about 35, 45K, right around there. Including everything, right, up front. And then it's all about doing it, marketing it, making it happen. That is not saying, oh, yeah, you just put it there and it'll all happen on its own. No way. There's the ongoing expense of selling it, marketing it. That's where the big expense is. But once that's working well, then the expenditures are outweighed drastically by the capital raised. Talked to several companies, Start Engine being one. Several have recommended doing a CF raise and use those funds gained to fund doing a Reg A plus. Makes sense. What's my opinion? I think that's a good approach. Personally, I do. We were not interested in CF initially, but that approach has come to appeal due to the costs associated with Reg A plus. Fair enough. So, yeah, so Start Engine is a competitor, sort of an indirect competitor, because their approach is very different than ours, but they do Reg A plus. So, they're an okay company. We have other companies we compete with. We're very different than them. I don't think you guys really want to hear me promoting my company at their expense here, but we're more actively engaged in our companies. We're more selective than our competitors. We do fewer offerings, but we're heavily involved because, frankly, my intention is that we will become the leading Reg A plus platform, period. And to do that, we have to have great offerings with great success and happy investors later on. That's everything we do is aimed at that. But again, that's too much self-promotion here. So I think Reg CF is really good. The fact that it's gone up to 5 million now, we're going to add it to our mix of offerings. We don't do it currently, but when it was $1 million, it wasn't worth doing. The only thing which complicates that with me is that we've been sort of hitting stride with Reg D, getting it to resonate, and it's really good, and it's an easier complement. It turns out that Reg CF is more restrictive from a marketing standpoint than Reg A plus. Reg D is less restrictive. So if you are doing a Reg CF with overlap with your Reg A plus, the Reg CF lowers the amount of marketing you can do. It restricts the types of marketing you can do in your Reg A plus to the Reg CF level, which is a problem. So, I wouldn't want to be doing them both at the same time, but doing them sequentially is okay. And then the only thing is to recognize that all these things take time. And if you're planning to do the CF in 6 weeks so you can get on with it with your Reg A plus, or 8 weeks or something, that isn't real. That's not going to happen. It's going to take longer than that. But CF is good. When we have CF, I would say come to us for your CF, and we'll do that as a preamble. That's why the Manhattan Street Fund, right? So the Manhattan Street Fund will invest and lend in companies to accelerate their Reg A plus without them having to go anywhere else. But it's got its own ownership and its own agenda. It's not going to just do whatever Manhattan Street Capital tells it we want it to do. Existing OTCQB issuers, not S3 shelf eligible, seem to be great candidates for Reg A Plus offerings. Yes, that's the case. You can do Reg A Plus can be used for secondary offerings for reporting companies, whether they're on the QB, QX, or the NASDAQ, or the NYSE. Reg A Plus is allowed for them as an S3 alternative to raise money. And in many cases, it's a really good way to go. And there have been some good success stories. The challenge has been that in many cases, early stage adopters of Reg A Plus for secondary offerings have been penny stock companies. And so then it's it's really challenging to sell the same security that is over there, even if you've done a reverse split and you brought the share price up. If it's still vulnerable, you can't be playing around with the share. You can change the share price and valuation in a Reg A Plus as you go within reason. But if there's a common stock that you're selling here and you're Reg A Plus, and this, can you see yeah, you can see. So imagine this situation. This is the common stock on the market right now, and that's its price. And you price your Reg A Plus here, and then for some reason somebody's nuking it over here, and the public listed price is down here. How are you going to sell these? It's much more difficult to do the Reg A Plus. So really having a separate security that the company sells is what I've seen as being the best model then, rather than trying to deal with this, because that fluctuation cannot be handled elegantly. Hopefully that was clear. Can you sell debt? Yes, you can. Reg A Plus is good for any legitimate security. And I mentioned Reg S earlier in the context. You can use Reg S to complement Reg D, right? We're finding it's very nice, the synergy there, where you're marketing the Reg D in the US to accredited investors. The Reg S is not restricted to accredited investors outside the US. And they are liquid, as I said earlier, as long as they don't sell to US investors. Interestingly, they can sell to US investors after a 1-year holding period for equity or 40 days in a debt instrument. So it's even, that's an interesting little twist. So yes, can a SPAC entity use Reg A Plus? With restrictions, we have a webinar we did on that, which you can look up on our website. It's one of in the blog area. The restrictions are that you can't do it as a pure SPAC. You can't do it as a pure blank check company. You have to have a business focus that is legitimate. And then you can buy companies galore. That's no trouble. But you have to have a business focus. So, for example, I'm a fan of AI machine learning. I think it's going to be incredible how much can be done with that. You could develop a company, a plan, and to build, or you could build technology for that in AI machine learning, and then essentially plan to apply that to a series of companies that you acquire. That is a legitimate. That's a SPAC by another name, right? It's a non-SPAC SPAC. So you can raise the money in Reg A Plus for that business, which is then going to go ahead and buy a bunch of companies. It's just that functional focus of the business must be legitimate. It can't be a sham, obviously, right? Can crowdfunding be part of the Reg A Plus? Well, donation crowdfunding isn't part of a Reg A Plus, but you can do it, right? You can raise money by that. Reg A Plus is crowd investing, right? As is online Reg D with 506C and 144A. It's crowd investing. But if that question was about crowdfunding donation-wise, you can do that with any company anytime. If you can convince people that they should donate, then that's a permitted thing to do. Can a Canada capital pool company? Whoa, I don't know. I would have to. I don't know what a Canada capital pool company is, so I can't add value to that. An entity that is listed in Canada can raise money in Reg A Plus in the US. A Canadian entity can raise money via Reg A Plus, but that particular entity type may be a weird exception. I don't know. I can't look it up right now. I don't have time with everyone else here. How much does it cost to do a Reg D, including marketing? Can you guarantee a capital raise? No way in hell we can guarantee it. But the upfront cost to do a Reg D, typically, you've got very big numbers to variables. If you assume a prudent and a modestly complex PPM, then it's mostly about marketing preparation. So I would say 40K-ish, 50K-ish to get ready. And then the real expense comes in when you are marketing it, right? So what you do though is, you are advertising and offering to potential investors, and you don't spend much money doing that. Maybe $100 a day initially, $200 a day is enough to adjust. And if it doesn't ever work, then you stop and you wasted some money, which is what we don't want to do. But normally we're able to adjust, tweak, and adjust the targeting, adjust the messaging, maybe have different offering pages that we bring advertising traffic to find out which one works, right? So then when we get to a point where the efficiency of conversion is high enough, which is what we've been doing this exact thing with our Reg D offering for the Manhattan Street Fund. As we get more efficient, I'm stepping up the spend because it's working beautifully now. But we've made a bunch of innovations around that, which I'm really jazzed by, many of which are proprietary. We're not going to tell anyone about what the heck they are because they're working so well. We're spending similar money now to bring in Reg D, Reg S investors as we will normally see in a Reg A plus. And I could never have said that before. That's the first, the last 2 months is the first time I could ever say that. It's a thing of beauty. No guarantees. No, we can't do that. It would be silly, wouldn't it? It would be silly for us. We have some clients to bring to you to do a crowdfunding offering, Reg A or CF. Can you talk about what MSC gets out of that and talk about whether a company can put their offering on multiple platforms simultaneously? Yeah. Okay, so on time we're doing okay. It really is imprudent to put your company on multiple offerings. Logistically, it's a nightmare keeping everything current and updated, and you really kill the marketing efficiency. If you try and drive marketing to multiple places, it's a disaster. You'll never ever achieve efficiency. And I'm not going to do an offering in that way because it's almost guaranteed to fail, or at least fail to be efficient, right? So we're not going to do that. But the other question was, what do we get? Okay, so our fees are these. We charge on a Reg A plus, we charge on a non-IPO, we charge $10,000. Each of these cash fees we charge matching warrants for. And it's a bit different in a debt offering, but I think just talking equity for a minute, that is to say the warrants have to be a little different in a debt offering. For 9 months, we charge consulting fees of $10,000 a month, plus warrants of the same face value. While listed on our platform, $5,000 a month, plus warrants of the same face value. And for each investment, $25, regardless of the amount invested, plus warrants of the same face value. Those are our fees. It ends up adding up to not much money. It's a very low cost fee structure. In Reg D, it's similar, but the listing fee is $10,000 a month because it's hard for us to make money on Reg Ds. And we charge $250 per investment, and that includes AML and the accreditation verification process. That's not a rich package for us either, but that's what we do. These end up being pretty low cost to the issuer, especially given the advisory services that we're bringing to these offerings. What's the optimum reg rule for issuing unrated bonds? I don't know. I think I can't really comment on that in an intelligent manner about unrated bonds. So I won't do that. If you'd like to follow up with me later, I'd be happy to look into it, but I'm not qualified right now to give you a useful answer. Long-term stock exchange got an SEC license. So that I'm assuming that's probably an ATS. ATS are great. From Robert Kibble. Hey, Robert, I'm glad you're here. Typical profile of companies exercising these routes to raising capital, size, history. Oh my God, lots of things. So particularly for Reg A plus. So Reg A plus works it isn't so much about the stage of the company, it's about the appeal. So I talked to a company recently where they take paper, used paper, and they recycle it by literally removing the ink. And they can do that more than 10 times. And the cost of the paper is less each, to buy the paper, if you will, is less. It costs less than the new paper in the first place. So what do you got? You've got an environmentally sensitive approach that will appeal to institutions that have that brief as well as to investors, and you have a way of saving trees. I mean, it's a very motivating thing. And my God, it's a huge business. Their model of business, their revenue model is to license to people like Canon and Hewlett Packard that make printers, because they have patents up the wazoo for this company. It's really well put together. Another overnight success. They launched it in 2014. Their market in a licensing revenue model where they don't deal with the customers direct is, because of the giant size of it, about $3 billion a year. Yes, you can do a Reg A plus for that company. They have no revenues, but they have prototypes working, and they have all sorts of other great indications of marvelous success. So it's sort of a startup, but it's not, because they've been building it for a long time, and it's such an appealing business. Whereas, we had a company that's stable and boring and not growing and not very profitable and hard to explain. We'll never raise money for it. How can you get it to resonate with people? Why would they buy shares in it? What's the ownership going to do for them? Unless they invert the business and come up with a strategy that is going to make it, a strategic business that makes it very, very attractive. So it comes down to, it's got to be really appealing as a company, because of the nature of what they do, treating Alzheimer's, treating cancer. Biotech can be wonderful. Solving problems that consumers care about, EVs, new battery technologies, things of that ilk, alternative energy, things that people care about, where they're good investments, where the prognosis is exciting. We have an issuer biotech company on our platform where they are making a COVID-19 test that isn't finished yet. It's close, and it's not FDA approved yet, therefore, but it's going to sell for about $120 in your pharmacy. It's a little device that works with your smartphone and gives you accurate results on COVID-19 and many, many other viruses as well as bacteria in minutes, 5 minutes to get a result, and it's going to cost about $20 per test. So yeah, that's relevant. Yeah, that's interesting, and they're doing incredibly well as they in their Reg A plus. So they had no revenues, and they're effectively pre-product, right? Then we have another company that I'm not going to describe in too much detail, but they're in a business. They're growing about 100% a year, producing about 85% pre-tax profit. You don't really need to know too much more than that, as long as it's real, right? And they are capital constrained. So that's an example of, whoa, it doesn't have to have a cast of thousands and 65 employees, So it's really about, can we explain it easily in online advertising? Is it appealing? And is it either an amazing investment, or is it doing something that people really want to see done? Okay, you have a treatment that if you're working on a preclinical triple negative breast cancer chemo that's gonna, that looks promising, that's gonna be easy to raise money for, as an example. What percentage of deals that are done with third-party escrow agent and without do you recommend one way or the other? So the logistics of it say that if you're going to process payments in the back end, where are you going to put the money, right? And you should use a transfer agent, because there are serious reasons with the SEC why you must use a transfer agent. So you end up having to have at least a segregated account, even if it's not escrow, where the money goes. You have to do it logistically. It isn't expensive, but you do have to do that. How are we doing on time? Okay, for a moment here. So your question was percentage. I kind of made that too elaborate an answer. It's 100% of the deals that we do. Since you all have different accredited investors in your Rolodex, could a company doing a raise using two companies to reach their goals, setting a cap on each company? Yeah, we wouldn't do it because the marketing would be a nightmare. But theoretically, you could do that, right? Um, the exception would be bringing in a broker dealer. But the way it works with broker dealers is that in an online raise, they're not going to take a risk and go to their clients until it's already successful. So we have to make it successful up front with the marketing. Once it's already a no-brainer success, then we can bring in a broker dealer to add value, but they won't add value until then because the reps from the broker dealer don't want to burn their client relationships. Imagine you're a rep, you've got a trusted client who loves you, you persuade them to invest in an offering, and then it falls on its face and never raises enough money, and they're out there wishing they hadn't made the deal. So that's why they don't do it. Can you issue a convertible preferred using Reg A plus? Yes, you can. I wouldn't do it because you can't explain it. The investors are going to get confused and they're not going to buy it. You need it to be simple to explain. Will the underlying common get registered? The Reg A Plus is an offering where you offer one thing. You don't offer two things because that makes it twice as complicated. You could do all sorts of things like that, but you wouldn't. You would. A Reg A Plus that goes public is like an S1 in the sense that normally, if you go to the NASDAQ, all of the preferred converts over to common, et cetera, just based on the way all the share classes were defined in the first place. But if you go list on a not on the NASDAQ, not on the NYSE in your Reg A Plus, then all the different classes stay as they are, although they're all theoretically liquid. Only the one that you sold is really liquid because you probably list it someplace. Should a company include anti-dilution provisions in a Reg A Plus? Good idea, good question. Yes, so you see different practices, but a lot of companies doing Reg A Plus will sell preferred, in which case they'll have weighted average anti-dilution protection typically, but not all companies do that. There are certainly some companies that do do short-sighted offerings, in my view, where they risk pissing off their investors later on, where the investors later on discover that they shouldn't have made the deal if they'd only known. We've got to make sure that we protect them from that so we have happy investors later on. Yeah, thank you, Akos. You're welcome to email me and us to ask questions. Fees for a 144A, I haven't figured it all out yet. It'll end up being a fair deal. We will provide the buying the security offering, the security from the issuer part, as well as the marketing it online part. We'll do both of those. And I think the fact that we're doing the buying part will allow us to have a nicer, an easier to implement fee structure than the one we have for our other offerings. So it'll end up being something. It'll end up being low cost because it has to be, right? And what's the point of doing this online stuff if it gets to be silly expensive? We have a group looking to raise dollars to acquire distressed debt with future operations, to acquire operating company, best route. Depends on all the different variables. This is, should I do a SPAC or should I do a Reg A plus question? If what you're doing fits what I said earlier, you got to make it viable to use Reg A plus. But if the nature of your plan appeals to consumer Main Street investors, then it may be much easier to raise the money. That's really the thing, right? If you have, Tom Hanks out there pitching it and you've got a really remarkably credible team, you can do an S1 SPAC and just go ahead and raise the money in minutes, not minutes, but you know what I mean. The problem with a SPAC now, the only problem with a SPAC now is you may find that the market's crashed by the time you get your S1 through the registration process, and a Reg A plus is much faster. You know, if you were to really, really crank and really were efficient and spend only 30 days preparing and then 60 days getting through the SEC, which could even be faster, in 3 months you could be live in a Reg A plus before the market crash destroys the demand out there for stuff. And the other thing about Reg A Plus is that there is demand even when the stock market's in a bad state of play. So, for example, last year when COVID hit and the market got decimated, we were still raising money when the market was decimated, but it cost 25 to 30% more per dollar raised. So it wasn't like the lights went out. It just got more expensive. And that's kind of interesting, right? That says that Reg A Plus online crowd investing is appealing to a somewhat different audience. Are there additional limitations using Reg A Plus for security tokens? You are not kidding, there are, yeah. The SEC is basically making it punitive to do blockchain security token offerings. If you're selling a security token via Reg A Plus, you've got to be a missionary that wants to spend megabucks and lots of time. So I wouldn't do that at this stage. The SEC will eventually make it easier, but we're talking years, apparently, based on the current state of play. Reg D and Reg S are fine, but not Reg A Plus. And 144A would probably work there too. But then does it appeal to those institutions, right? There'll be really nifty things done in blockchain. Looking to raise capital for industrial real estate development, horizontal and vertical construction, real estate. I mean, Reg A Plus, over 65% of capital raised via Reg A Plus has gone into real estate deals. It's really working really well. So I recommend it. Looks like I've reached the end of the questions. Am I right or am I wrong? Looks like it is. All right. And we've also taken ourselves to the hour. So if you have more questions, ask them now. Otherwise, I'll start winding down here. One of the things I want to convey to you is this. I decided to do this company in April of 2015 because of Reg A Plus. 5 weeks later, we went live in May of 2015, about a month before Reg A Plus went live. We were the first dedicated Reg A Plus platform. And, you know, it's taken a long time, but it feels to me like we're one of those overnight success stories, but it took 6 years in the making. That's the bottom line. It is astounding how much better the climate is today for Reg A Plus. Obviously, the bubbly stock market is helping, but it's not just that. It's the COVID thing. It's the online investing thing has been accelerated by people being trapped at home for so long. I don't know exactly whatever, you know, I can't be precise. I'm giving you my interpretation of the why, but the is it happening part, it's astounding. The number, I would say that in the last 4 to 6 months, even over Christmas, the quality and quantity of companies that have been approaching us is just 4x what it was a year ago. Amazing, really, really impressive. So that's why I'm so jazzed about things at the moment. And the other thing that I'm really jazzed about is that we found ways to reduce the cost of marketing that I would never have been able to hope for 6 months ago. So, you know, Reg D, Reg S, where we're making amazing efficiency in our marketing. All right, I'll check for more questions. I don't think I'm seeing any here. So I sincerely hope that this, do I think there's room to sell real estate backed bonds at a 6% rate? I think 6% is too low for a Reg A plus. That's probably not going to be exciting enough. No, we're not at a capacity limit. We've actually been gradually building the scale of our team. Did you understand me? Then I said, if you raise a fund in Reg A plus, that fund can't take controlling interest in the company it invests in. No, I was saying the other way around. Reg A plus lends itself to a venture fund if the venture fund buys a controlling interest, or a private equity fund for that matter. When you buy a controlling interest in the target companies, it's set up well for that. Essentially, when you own less than a controlling interest, the SEC is worried They don't want you to do a mutual fund without the regulatory overhead of being a mutual fund, without that level of constraint, right? So if you own a bazillion, if you own equity positions in a bunch of companies and they're all tiny positions or less than 51%, less than 50.1, 51, then you can't use Reg A plus, basically, unless you fit with that 60-40 thing I mentioned earlier and some other caveats. So we're talking to a company now in biotech, because a lot of biotechs, the scientists don't know what the hell they're doing. They've got something amazing, but they don't know what they're doing. And no insult meant to any scientists that are on this call, but they need help. And so this fund they're putting together a venture fund, and it'll own the whole company at first. It'll set up companies for inventions with scientists, and then it'll baby those companies through. So it's a beautiful fit for Reg A plus, because they're going to own 80-90% of the companies, so, at least in the very beginning. Have changes in VC and PE funding influenced the growth of Reg A plus? Well, yes, because so much of the VC is late stage stuff. That's one factor, and private equity hasn't really changed much. But even private equities, because of the state of the market, they want bigger deals. So Reg A plus is typically a Reg A plus company is too small for private equity, too late stage for VC, or in a business that isn't on the list for VCs to be interested in. There's a lot of businesses that are very attractive that VCs don't like. Those are the sorts of things. And then it's because the entrepreneur is worried about losing control of their business. Yes. The question is, do we have a list of recommended service providers? Absolutely. So that's a big part of the value add, right? Because we've got people that work with us all the time in all the different roles that we know and trust, and that are cost effective and efficient, time efficient and responsive, because we bring them a lot of clients. So it's a what's the word? It's a honest broker thing. We don't charge fees on them. We're not getting paid backhanders and stuff. That wouldn't be acceptable, obviously. It's really about how great they are, right? And how you would be amazed what we learn. Some of you guys know this. You bring in a big auditing firm, and they're medium, big. They may quadruple their audit costs later in the game because there's some surprising development that arose. There are companies that do that as a regular matter of business. So, avoiding those guys is a big deal. We have a blacklist of such auditors, but it isn't really difficult to avoid them. But that matters, that sort of thing. Anyway, yeah, we do. We have specialists, especially in marketing. That's the most difficult one. The big agencies with the big name and reputation charge too much. They expect to charge too much, and guess what? It ends up costing too much. It has to be agencies that are small and fleet of feet and trying to prove themselves. It's like this conveyor belt, right? They get too good. Then we don't use them anymore. They get too expensive. They get too cocky. No, they get to the point where they don't think they need to charge good prices anymore. Is space commercialization and post-COVID risk mediation interesting? Yes. In the right instances, yes. Saw a company recently that's doing space commercialization. That's a really attractive category to be in. Hey, Fernando. Yeah, thank you. And of course, for companies outside the US, they can use Reg A plus too, with the hassle factor that they need to set up a US entity in an appropriate manner. Okay, so I think I'm going to gradually wind us down here. Again, I hope this has been really helpful. Thank you, Akosh, very much for setting this whole thing up and making it work. We will be sending out, in about a week, 10 days, we'll send out an email inviting you to the blog post, which will have a clickable indexed version of this webinar with any screw ups that I might have made, erase. Hopefully there aren't that many or any, but we'll see. And let me see. Yeah, that's the important stuff. Thank you very much for being here. I hope this has been helpful to you. I really hope that the whole purpose of this is to up the game, right? To do a better job. And I look forward to working with those of you for whom some of this is appropriate. And I think that 144A program will have great legs in the right instances. To me, it's a very interesting instrument to build upon.